Welcome to Exchange Traded Fridays, ETF.com's weekly podcast. I'm your host, Sumit Roy, senior analyst here at ETF.com. So the tariff-related volatility that hit the markets last week continued into this week, pushing the S&P 500 closer to correction territory. As I'm speaking, the index is a little over 9% off its recent highs, so just shy of the 10% threshold that many consider to be the start of a correction. So what does this all mean for ETFs? Well, we have been seeing some really big moves in the ETF space as the market teeters on what could end up being a double-digit pullback. So we're going to break down the most interesting ETF action that we're seeing this week, and we're also going to highlight some of the biggest stories that we covered here at ETF.com. But stick around because after that, we're going to have a very special guest that we'll be speaking with. Dodd Kitsley, who's the national director at Davis Advisors, is going to talk to us about the tremendous growth that we've seen in active ETFs. He's also going to tell us where he and his firm currently see value in the market. So you absolutely do not want to miss that. Stick around and let's get into it. Joining me today are my incredible colleagues, senior content editor Kent Tooney and contributing editor Ron Day. Guys, always great to be here with you. How's it going?
It's going all right, Sumit. Glad to be here.
Yeah, pretty crazy week.
Yeah, that's an understatement, Kent. I just talked about how we're nearing that 10% threshold on the S&P 500, but obviously the S&P 500 isn't the only place we're seeing action. What have you seen this week, Ken, just in terms of the macro data and market moves?
Well, at least for writers and investment advisors like me that watch the markets a lot, there's not a great surprise. I mean, you talked about the S&P 500 correction territory. I saw on Tuesday, right at about 1:30 p.m., I'm looking at a chart right there, the S&P 500 intraday did touch the 10% correction level, or maybe just a point or two before it. And why I say it's not surprising is that a lot of investors, especially traders, there's often a bounce off of a 10% correction. And so a lot of traders are putting in stops. Some traders call it the algos. Everything is just set to buy on that 10% correction level. So right on cue, when it hit that 10% correction point or a few points ahead of it, the S&P 500 turned around. Now, as we're recording this Thursday afternoon, it's almost at that point again. The S&P 500 down 1%, and so by the time listeners are tuning into this podcast, we may be at that 10% correction level again. Other things that are not that surprising to me is, defensive areas doing better. I see a lot of investors looking at dividend ETFs, SCHD, the Schwab dividend ETF, one of the most popular dividend ETFs out there, performing well, outperforming the S&P 500. I wrote a story on that, how it was up 4%, almost 5% as of Tuesday, when the S&P 500 was down almost 10%. That's a 15% differential between a dividend ETF and the broader stock market. So that really, to me, is the story, is just the S&P 500 heavily weighted toward technology, down close to 10% or right there at it. And other areas that are more stable, like dividends and say consumer staples and those type things, are actually doing pretty well this year.
Yeah, you made a good point, Kent, that people have stepped in over the past 2 years when the S&P 500 has gotten close to that double-digit correction territory. We're recording this midday on Thursday, so by the time people are listening, maybe the S&P 500 is close to 10% below the highs. We're not sure, but as of right now, the worst that we've seen in terms of this pullback is a close that's about 9.3% off the high. And this isn't the first time we've seen this. Obviously, in 2024, there was another pullback of similar magnitude. We saw an 8.4% pullback in mid-2024. But in order to see an actual 10% peak to trough decline. You have to go all the way back to October of 2023. That's the last time we saw it. That one was about 10.3% down before it rebounded. And that was, of course, when the market was coming out of that bear market that we saw in 2022 because of high inflation and high interest rates and things like that. So it's been quite a while since we've actually seen the market close 10% below its highs. It's been 16 months since we've seen that. Maybe we finally do see that. And it's not unusual, right? If you look back historically, the market tends to see a double-digit correction every 1 to 2 years. So, yeah, we're talking about the trade wars and the tariffs causing this sell-off, but it might have happened regardless of anything, right? We always see a correction for some reason or the other. There's always something to point to that's causing that sell-off. In this case, we can point to the tariffs and the trade wars, but you have to expect a correction. It's always going to be, it just comes with the territory of being an investor in stocks. They go up and down.
I guess what feels
Yeah.
weird is when you have a sense that the commander in chief is pushing the correction, that it's kind of like a self-inflicted correction. You know what I mean?
Yeah,
That's
that's
what feels
fair.
kind of so jarring. Is it doesn't feel like, yes, you talk about a cyclical thing, but this seems to be something that it's like we're watching it happen, somebody's hands on the on the wheel, just steering it over the cliff.
Yeah, I would word that similar to what you said, Samit, and kind of combining what you're saying, Ron, is that really the correction we're seeing was a correction waiting for a reason to happen. And so
Right.
a lot of traders would call, the tariff war and what Trump is doing more as a catalyst rather than the cause. So the correction was coming, but we just didn't know what was gonna cause it. Now, hopefully, we don't get more than 10% correction. And I think how much further down the market could go would be a prolonged trade war potentially.
Yeah, right. So, yeah, that makes total sense. We were bound to get a correction. This was the catalyst, but where we go from here ultimately depends on how this trade war manifests itself in terms of economic growth. How much of a hit are we going to take in the economy and potentially in corporate earnings? That is the big question. And no one really knows that. It seems like the administration is willing to take short-term pain for what they see as potentially long-term gain. And we'll see, right? I mean, we're early in the Trump administration. There's no elections until November of next year. So perhaps they're willing to take short-term pain and in hopes that the economy recovers sometime in 2026. I don't know.
Right. Yeah, I agree with that. Yeah, they can take a lot of risk now without the consequence of losing an election. And so they have about a year or so to get these things done, but that's not a lot of time in politics. So it'll be interesting to watch, and we'll definitely be covering it.
Yeah, absolutely. So, Ron, you wrote an interesting story this week on ETFs related to Europe. Isn't that right?
Yeah, the theme of it was that while we're feeling a lot of pain over here in this kind of trade war that we launched, it does look like Europe has the early edge in this battle. Goldman Sachs and JP Morgan both increased their outlook for European growth this year, while also uh, rolling back their estimates for US growth a little bit. And what they're seeing is that looser monetary policy in Germany, as well as Europe's defense sector, firing up, which is kind of interesting. It's the Trump administration has told Europe to start funding its own military efforts a little more, and what's happening is their defense sector seems like it could be pushing the continent's economy, while at the same time, we're seeing consumer spending kind of pull back and those sorts of things.
Yeah, and we've been tracking that one Europe Aerospace and Defense ETF, EUAD. It's still up 39% so far this year. And European and international stock ETFs in general have been sharply outperforming US stock ETFs. I don't think anyone was predicting that entering 2025. Isn't that
No, I
right,
mean the
Ken?
convention. Yeah, you're always told like stay in U.S., stay in U.S., and U.S. is always ahead. But
Yeah.
the VGK, the big Vanguard European ETF, is up. Well, as of yesterday, it was 12% higher and big inflows, while SPY is 5% lower with like kind of very paltry inflows.
Right. Now, I will add that advisors like me are getting a little bit of a last laugh, if you will, because diversification is incredibly important for in portfolio construction, and we're seeing several areas that are classic diversification tools, like you mentioned Europe stock, but also bonds and gold are outperforming the S&P 500, and so. Those are kind of boring areas that were lagging for the last couple of years, and now they're leading. And so it's a testament to diversification and long-term investing.
Absolutely. Yeah. There's always that question. I mean, after seeing years and years of US outperformance, and particularly outperformance in US big tech, everyone thought, why diversify? Just pile into the Mag 7. But it's times like these where the benefits of diversification really are visible. There's always this debate also about, whether US based investors need to have international ETFs in their portfolios because you kind of already get some exposure to international markets through the multinational corporations in the US who do business outside the US. I don't know, where do you come out on that debate? Do you recommend to your clients including international ETFs, or do you think they already have enough exposure via the big US corporations that do business globally?
That's a good question. I'm kind of mixed on that. For example, some of my younger clients, when I say younger, I mean say 30s or 40s. They emerging markets could be more appropriate for them, or even picking a country ETF. Right now, I'm writing on an article that will be published probably by the time this podcast is published. 10 best ETFs for the next decade, and one of them in there is EPI, an India ETF. So if we're going to pick countries or foreign countries, emerging markets, I like picking countries like India that have long-term growth. So it's kind of a long answer to that, but that was
Yeah.
my shorter answer.
And I haven't seen the piece yet, Ken, but is QQQ on there by any chance?
QQQ is on there. Some of the classic long-term, and of course, VOO, Vanguard 500 Index. I mean, if you're going to pick one fund, then you might go with an S&P 500 index. If you're more aggressive and you want to pick one fund, QQQ might be it. And then we'll have to look at the article to see the others, but there's some interesting ones in there that you may not have guessed. But speaking of QQQ, this week marked the 25th anniversary of the dot-com bubble peak. And QQQ was exactly 1 year old when that hit. So QQQ was launched March 10th of 1999, and the bubble peaked March 10th of 2000. And coincidentally or ironically, this March 10th was Monday, and one of the top performers was SQQQ, an inverse QQQ ETF. It was up like 8% or something like that, or maybe 12%, which I thought was very interesting. And there's an article that we have on our website on that if anyone wants to see more on that. But I thought that was very interesting this week.
Yeah, that is interesting. And I did see a couple people mention on X how it's the anniversary, and now that we're selling off, everyone's like, is the bubble bursting? But obviously, the QQQ today, the NASDAQ 100 today, is very different than it was in the year 2000. The companies that are in the index are just so dominant. Doesn't mean they can't sell off, as we've seen over the past couple of weeks. They're down 15, 20% in some cases, but these are some of the strongest, most profitable companies we've ever seen in the history of capitalism.
Hey,
right?
Samit, if I can, Kent gives me the opportunity to shamelessly plug a piece I wrote and our awards banquet on April 23rd. I wrote a piece about our Lifetime Achievement nominee, Bruce Bond, who is the CEO of Innovator. He, in around 2000, he had started Power Shares, which owned QQQ for a little while. And QQQ with it was then sold to Invesco when Invesco bought out Power Shares to start their ETF business.
Right.
So,
Yeah. Back
you
then it
know,
was called QQQQ. It was four Qs.
oh, all right.
That didn't roll off the tongue as well.
No,
Yeah.
Right.
But yeah, definitely go check out that piece. That was a great piece from you, Ron. And yeah, I mean, great discussion. We'll continue to follow the markets. I'm sure the volatility isn't going to be ending anytime soon. I think this is a great place now to turn to our special guest, Dodd Kitsley, who's the National Director at Davis Advisors. He's going to be diving deep into active ETFs with me. Dodd, welcome to the show.
Thanks so much for having us.
Absolutely. So, Dodd, I think you're the perfect guest to have on the show because obviously this year, just like last year, we've seen tremendous demand for active ETFs. And Davis was actually among the first to issue active equity ETFs. Why don't we start there? What led you to enter the ETF industry back in 2017?
The genesis of ETFs at Davis Advisors, and way before kind of the massive growth that we've seen over the last few years in the category, really came from our existing clients in mutual funds and separately managed accounts. And clients about a decade ago approached Chris Davis and other employees at Davis Advisors and asked, hey, can you offer the same strategy, the same type of portfolio that you do in a mutual fund, but can you do it in an ETF? And we're really grateful that they approached us because it was really the impetus to do some due diligence and really kick the tires, if you will, to find out, A, is it possible to do an active strategy? And then B, is it really practical as well? And we launched in January 2017 with 3 ETFs, and then one to follow the following year. And as they say, there's no such thing as an overnight success. And it's taken a while for folks to really embrace actively managed ETFs and be aware that our strategies and others are available in this really compelling value-added wrapper. But we're very, very pleased that not only the category has become relevant and of interest as of late to investors and advisors. It's incredibly gratifying process, and we're really pleased.
That's fantastic. So it's been now 8 years that you have been in the ETF industry. You said you launched those 3 ETFs right after you entered the space. How many ETFs do you offer today, Dodd? And can you tell us a little bit about your lineup as well as your investment philosophy?
Yeah, thank you for that. Yeah, we have 4 ETFs, so we'll quickly go through kind of their tickers and more importantly, their characteristics. Our flagship is DUSA, affectionately referred to by many as DUSA. And that's our large cap value approach and portfolio. And that's really modeled after our large cap strategies that have existed for more than 50 years. So same investment philosophy, same approach, what have you. Then we have international at DINT or DINT, and that's our best ideas outside the United States. Combining the two are really open, highest conviction idea of opportunities across the globe is captured in DWLD or D World, if you will. And that's our least constrained portfolio. And then finally, DFNL is exposure to our top ideas and businesses in the financial industry, which has been a core competency of Davis for a long time. In fact, Chris Davis launched our financial fund over 30 years ago. So what you get with our ETFs is a few things beyond just the benefits that traditional transparent ETFs offer. You get first and foremost, an experienced research team, a team that's been doing this for many decades, in over many decades together. So we're a learning-based firm. We always, debrief on mistakes that are inevitable in any business, but especially in the business we're in of managing equities. And we learn from those mistakes. And so you have a research-driven process from a highly experienced team. And what you get as an output is a very high conviction, best ideas portfolio within those kind of areas of interest, whether it be large cap value or international equities or financials. They're really reflecting our best ideas, and they look nothing like the broad index. We have active share in the 80 to 90% range. So it's a very differentiated type of portfolio. And really what we're looking for are businesses that we can own over a long period of time that are going to be compounders of wealth, and that are really best in class businesses with very good balance sheets, strong balance sheets, to be able to withstand perhaps a recession in the future, and actually grow market share during an environment like that. Companies with very good management teams, we really kick the tires and get to know the businesses that we own as if we were buying the entire business. So we put a premium on management teams that are very good capital allocators, that put shareholders first. So for folks looking for quality, for folks looking for durability during an uncertain time, we're certainly going through a lot of transitions in the market. High quality portfolio of businesses that are going to grow earnings over the long term. That's really what you get. It's just tie it up in a bow. We compare very favorably to not only the S&P 500, but the Russell 1000 value by being selective, by being very discerning in the businesses we own. So essentially, the result is a portfolio with, in DUSA's case, of a 14.5 forward multiple, compared to about 20 in the Russell 1000 value, which surprises a lot of folks, with value being so expensive. And then the S&P 500 at over 25 times. Yet, the companies we own have had demonstrated earnings growth of over 21%, which compares favorably also to the S&P 500 at 17% and the Russell 1000 at less than 10% earnings growth. So we strike that kind of balance of giving and providing a best ideas portfolio, and really eliminating the companies that we think could drag down performance and are ones that maybe have a lot more risk to it. So that's it in a nutshell. And thanks for the opportunity to share about the products.
I want to dig deeper into DUSA specifically in a second, sure. Dodd. But before we get there, you talked about the uncertain environment. Obviously, everyone's reading the headlines, seeing the volatility in the broader financial markets. Where are you finding opportunities in today's market environment?
Yeah, it is a very uncertain environment, yet I guess one could argue that almost every environment is uncertain, but
right.
We're certainly going through a lot of transitions, right? We're going through an economic transition where we're coming out of a period where it was very unnatural to have interest rates near zero. Free money, if you will, and that just can't persist forever, and it has reverted back to a more normal type of interest rate scenario where fundamentals matter. Obviously, we're going through a lot of geopolitical uncertainty right now with wars and the divisiveness between political parties, not just in the U.S. but elsewhere. And AI has created such an inflection point in technology, so we're going through a massive transition there that everyone's trying to get their hands around. So where are we finding opportunities? We're finding opportunities in several areas. First and foremost, in financials, in being very selective within financials. It's the most diverse sector in our market, in a large one at that. So dominant banks, such that are able to really have scale and build market share during times where there is stress on the financial system overall. Some insurers are certainly some compelling in that environment as well. Within technology, dominant players that have pricing power, such as online advertising companies, semiconductors is a way of playing AI, but not maybe the most apparent straightforward ones like in NVIDIA, but more of the picks and shovels that are going to be huge beneficiaries, providing semiconductor equipment and manufacturing resources. And then in healthcare, we're seeing opportunities too, but probably not in the areas where folks would think. And usually when one thinks pharma, they think healthcare, they think pharma or biotech. To us, it's really in the too hard pile, with patents being approved and a transition from patented drugs to more generics. So we're focused in healthcare in companies that are really adding value to the system and helping to control costs and providing a better experience. So several companies in the managed care, Medicare Advantage, if you will. So playing several companies there, because it's not a winner take all, but it's one that will benefit over a long period of time. Diagnostic lab testing that is driving down costs, generic drug manufacturer that's dominant yet very, very attractively valued. So those are kind of the general areas within. So we're trying to play some of these kind of long-term, really transformational themes, but doing so in a very selective way that may not be is straightforward as one's knee-jerk reaction to say, oh, healthcare, I'm going to buy a pharma company and the biggest companies out there. We're looking for really the best long-term opportunities for companies that can both be durable as well as grow earnings over the long term.
That's great. So Dodd, Davis has been around for a long time. You guys have a over 5-decade storied history. You've been in the ETF space now for 8 years and counting. What do you think sets Davis apart from the other value managers that are out there?
It's such a great question. Because certainly, the label, the category that one's in doesn't really tell the whole story. And I think when one looks at large cap value, there are over 800 line items, stocks in the Russell 1000 Value Index. It's very diverse, and we're very different than the index, right? So first and foremost, we have a unique portfolio that is truly our best ideas. 27 to 35 stocks, depending on the portfolio and in the time. So it's incredibly selective, and that's an important part of our process. When people think value, they sometimes will think deep value. And Davis in our portfolios, like DUSA, is clearly more in the Buffett camp than the Benjamin Graham camp. So we're really looking for wonderful companies at fair prices, as opposed to fair companies at wonderful prices. So we're not deep value at all. We want companies that have that durability and the ability to grow earnings and their market share over periods of time. So That's kind of where we are. Within value, we've seen a lot of popularity over the last few years on equity dividend products. We know the environment's changed a little bit, and because there's been so much demand for high dividend payers in the markets over the past few years, it's driven up valuations to a point where we're not seeing as compelling yields or opportunities long term in that space as well. So, in a nutshell, research driven, very thoughtful selection of a handful of companies that, as long term investors, we think will build wealth for our shareholders.
Now I want to turn back to DUSA. I'm looking at the performance right now, and it's been a great performer, especially when you compare it to the Russell 1000 Value Index. If you look at DUSA since inception, it's up something like 134% versus 98% for the Russell. Really strong performance there. Why is the Davis Select US Equity ETF DUSA compelling in today's environment specifically, Dodd?
Yeah, thanks again for asking that question. I think that's really most important. And we really believe that DUSA is built for the environment we're in right now, an environment where, again, we're going through these huge transitions. Perhaps the biggest is the economic one in the level of interest rates. And certainly, we've been out of sync at times with the market when it's more of a momentum-based type of scenario, and where stock prices and business results diverge, and we've seen that over the last few years. Yet still had very strong performance. But in today's environment, fundamentals matter. Earnings in the future are incredibly important in the ability to grow those earnings. And when rates were zero, it was really just about the today and the here and now. So that is one where I think being selective and doing your homework, doing research, and putting a premium on companies that are standing out as not only leaders today, but leaders in the future is so important. And we believe that what you don't own is going to be as important as what you do own going forward because of that environment. So it's one where you think about the concerns on investors' minds today. It's about a recession. It's about interest rates and the volatility we're seeing there. It's about uncertainty in the geopolitical arena. And I think our portfolio, DUSA specifically, addresses all of those concerns by being in durable, well-managed companies, strong balance sheets, yet attractive earnings growth. So it's almost like you can have your cake and eat it too, and you don't have to default to a very richly valued market, one that can argue is run a little bit long in the tooth over the last few years.
That's great. And it certainly seems like it's resonating with investors. We did see assets under management in that ETF hit a high recently, over $700 million. We've also been seeing tremendous growth in active ETFs in general, Dodd. And that's what I want to ask you about. We write at ETF.com about how active ETFs have really taken off over the past few years. It used to be just a completely index dominated type of industry. That's no longer the case. What do you think is driving the recent interest and growth in active ETFs?
What's really driving it is, it might sound simple, but it is genuine investor interest in awareness. And putting a little meat on the bones there, it's you're right. I mean, ETFs for so long in the 30 plus history here in the United States that ETFs have existed, and gosh, I mean, who would imagine it's 30 years? They're not new anymore.
Yeah.
But folks would equate ETFs with indexing, and the eureka moment, the light bulb really has gone on for so many investors now that they recognize that ETFs aren't just about indexing, but what ETFs are really about is providing a more efficient way to gain exposure. And those exposures certainly can be indexes, market segments, themes, and active strategies. And active ETFs are really punching above their weight. Last year was a record year for the industry at large. We took in over $1 trillion in assets. So putting U.S. ETF assets over $10 trillion, representing almost half of the mutual fund industry, which has just been an amazing compounded annual growth rate that we continue to exhibit. And we saw a lot of products coming to market as well. 750 were launched last year. And to put it in context, while active ETFs represent 8% of the industry assets today as we speak, active ETFs accounted for 26% of every dollar invested in the ETF industry last year. So 1 out of $4 went into active strategies, and 76% of the issuance was active strategies as well. So you're looking at an opportunity set right now of over 1,800 active ETFs on the market today. That represents about half of all ETFs, which is amazing, and I think a real positive development for the end investor, because your toolbox is really over the last few years expanded immeasurably, and that's a really good thing.
Yeah, just absolutely incredible growth we've seen in active ETFs. And it certainly seems like investors of all stripes are now using these funds in their portfolios. Before I let you go, Dodd, I want to ask you, how are advisors using your strategies within their allocation models?
Great question. So we're seeing advisors use our ETFs in a variety of different ways, but the most prevalent is being able to really differentiate their portfolios within U.S. large cap. And what I mean by that is being able to have a sleeve in their portfolio that is high conviction, that's highly selective, and delivers characteristics that I think are desirable for all of us. A durable collection of 20 to 30 businesses that and show promise for growing earnings at an above average weight, but are valued at over a 40% discount to the overall market. So that is really compelling to folks, and certainly we're seeing some use it as their entire large cap value allocation, but more often than not, our ETFs, DUSA as an example, pairs incredibly well with uber low cost index investments, which many do like that extra diversification to own the market within a sleeve in a portfolio, but also be able to differentiate yourself. So we fit really well there. We fit really well with other active managers that are more benchmark aware or look more like the benchmark. We'll take meaningful deviations from the benchmark, omitting full sectors that we think are not the right ponds to fish in at the particular time, and having a 2x or 3x weight to some sectors we think are particularly compelling at the macro and micro levels. So pairing us with other investments, I think really adds a tremendous amount of value and will continue to going forward, but also differentiates oneself from merely only owning the market and doing so in a passive, exclusive vehicle type of manner.
Fantastic. Well, we're going to have to leave it there. Dodd, you gave us a ton of great insight. Thanks so much for your time.
Well, really appreciate you guys having us on, and really appreciate the work you all do. So thank you.
If you haven't already, subscribe and follow us wherever you get your podcasts. And if you have a question or you want to share your thoughts, Join the conversation with us on X. Our handle there is ETFCOM. Catch you next week.